Are we at the start of financial crisis 2.0?
I don't think so, actually. I think we've got an emotional crisis. I think we do have some structural problems. I think essentially the banking system in the U.S. has become, a giant money market fund where we've seen the growth of securities portfolios by the banks really in line with asset growth, but the percentage of those that have moved into Treasury securities is now a full quarter. So actually we were at $23 billion of Treasury holdings in all U.S. banks back in 2009. It's now $1.4 trillion. And so there is a mismatch there. There is a problem there. But to just shoot anyone who is upside down in their Treasury portfolio ignores the fact that really the issue is more, or is as much, about how much cash on hand do you have, how much short-term liquidity do you have, and how lumpy is your deposit base.
Okay, so you point out the differences between now and 2008, but we have this renewed sell-off in U.S. banks, including the big banks, we should mention as well. How much of that is spillover from Credit Suisse, as Oliver was just telling us, or how much of this is a clear sign that the regulatory response that we got over the weekend was simply insufficient?
I think it's more the latter than the former. And especially when it comes to the big banks, though, I would caveat, the big banks have very diverse deposit bases. So the majority of folks who have their money in those big banks actually don't have to worry about deposit runs. If your money's in those banks, now further, Dodd-Frank essentially codified them the same way that Credit Suisse is ultimately as sovereign debt. And that's the functional reality of it, whether we like it or not. So I don't think that the big banks should be feeling it that way. I think it is just sentiment, the banks going down, playing it in the markets. And that's really where the concern, I think, is more reality. But I think that we don't have the same problem. Now, in terms of the program that was launched over the weekend, to take long-dated treasuries at par is, to me, the problem, because it's a one-year program. At the end of the year, if you haven't forced banks to raise capital or find a way to fill those gaps, you're going to have to extend it. And I think that's really more what the markets are seeing in terms of the U.S.
Well, that gets to this idea here of what the market is really scared of right now. It isn't so much just about bank failures, but it's also about the idea that this is going to be an albatross around the neck of a lot of banks for quite some time.
That's right. And I think that's reality, except we didn't see a program, at least not launched publicly, where if you are going to access the liquidity from the Fed, where you're getting par instead of current mark on your long-dated and your held-to-maturity portfolio, if you don't force the banks to raise capital, now I know the answer will be, well, but it'll be dilutive now. Then what really are you solving? Because you got to remember, as a perfect corollary, back in 05, 06, Hank Paulson and Bob Steele told Fannie and Freddie they needed to raise capital, and the company said, it'll be dilutive, the markets aren't really conducive to that. And by waiting, we ended up in a situation that when we had the broader market or economic problems occur, they were short that capital.
And eventually everyone was forced to accept capital raises anyway.
Exactly. And I think that, unfortunately, is where we're probably heading. Not now. I expect this to be a 1 to 2 year out issue.
Well, this also raises the question of who is actually going to be, I guess, for better or for worse, the spokesperson, the one who sort of brings everybody off the ledge. There's been a lot of questions as to why we haven't heard more from the administration here in the U.S.
Absolutely.
I know we're expected to hear from Christine Lagarde, a pre-scheduled appearance by her tomorrow, and she's going to be forced to address this. Who fills that role right now?
Well, I mean, I think in some sense it's rightfully the Secretary of Treasury who should be. And I think, as I said over the weekend, I'm not a big fan of incrementalism in the midst of crisis. And so I think, as much as Scarlett remembers, I was not the biggest booster of Hank Paulson back in the day, but his acknowledgement and addressing it with a bazooka was the right approach.
I'm just curious, just on that point, do you look at him more favorably now than when you did in
I
the
do.
moment? Yeah.
I absolutely do.
He had the foresight. So what's the bazooka response to today's
Well, I mean, we've got several problems here, right? So, I mean, to me, one of the things is Credit Suisse is ultimately a government-guaranteed bank. That's the reality. The government has to rescue it. The government's going to have to rescue it. I don't see another option for the Swiss economy. I don't see another option, period. So we opened the swap lines out of the Fed to the Swiss National Bank, and I think that's where we're heading on the international side. Domestically, I think our big banks are actually in fairly good shape, even the ones that have large amounts of underwater held-to-maturity securities, because, again, they've got stable deposit bases. They've actually now, because of the concerns about regionals, have growing deposit bases. And they've got plenty of liquidity on hand. I'm not particularly concerned. I think it's sentiment more than it's reality right now. And again, we've been choking off bank allocation of capital to the real economy because they've been able to become money market funds and surf the curve for the past several years. I think we're seeing a reversal of that. But the whole situation, the whole crisis puts us in a position where the Fed is ultimately going to be tasked with choosing a binary path. Do we save the banking system, or do we actually
Fight inflation.
Fight inflation? And so I expect at some point we're going to have to see a tacit or explicit acknowledgement that, one, they halt for the moment, two, they end up going back in a hike trajectory, but three, we ultimately have to accept higher targeted inflation rates.
Do they make that clear? Do they articulate that next Wednesday, or is that too soon?
No.
I think next Wednesday they actually restate that they're pausing now, but they expect to get back into a hiking trajectory.
When it comes to sort of the insulation, if you will, of U.S. banks vis-a-vis what's going on with Credit Suisse and over there in Europe, how much, I guess, comfort do you think investors can take in that insulation? It's one thing to look at the balance sheet and say, okay, the numbers are they're copacetic, at least over here. But as you said, this is also about sentiment.
This is about sentiment, but again, most of the banks are, other than their HTM portfolios, most of the banks are actually fairly good. Yes, you've got some commercial real estate loan issues, fine, and but that's really bank specific. So I don't see a larger systemic problem here.
This may be a dumb question, but and where's the money going? I mean, we've seen it come out of some of these banks. We know that some of it has gone into other deposit accounts, and a lot obviously flowing into money markets here.
Right.
Does that matter that much to the Treasury and to the Fed, as long as that money stays in the system in some capacity?
No, I don't think it does, and I think that's actually part of the point is people somewhat irrationally, banks, even small banks that have well-diversified deposit bases, in other words, the majority of their deposits are under 250, they should actually be fine, but the sentiment right now is forcing people to line up even at those banks and say, I want to go into a GSIB bank because I know that they're ultimately government guaranteed. And unfortunately, that's why I was against Title II and Dodd-Frank Act. I think that we've created this sort of reinforced moral hazard again.
So just to jump ahead here, is there a solution that involves technology that could maybe ease the way for regulators like the Fed, like the Federal Home Loan Deposit Service, to do something and do it quickly?
I'm not sure I'm understanding the
blockchain,
technology.
crypto, for instance.
Oh, well, blockchain, absolutely. Look, the reality that we have quarterly call reports filed by every bank, when the reality is we could actually have all of the metrics in the call reports on the blockchain real time. The regulators can look in, see counterparty and party exposure real time in any one of the criteria of that. It's insane that we haven't. And then in terms of some of the crypto-related or digital asset-related businesses, I think there is stabilizing aspects to it. Again, not the more speculative ones, but I think in terms of a dollar being a dollar, I think that is actually stability. But one of the things right now is we also need to see the ability for corporations to feel safe banking, and that puts us back into sort of the old promontory financial, where you can have a money swept into various bank accounts at various banks to keep you under the 250.